Bringing you the latest in tax credit news, this is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the March 28th, 2023 podcast. In this week's episode, we're covering a very timely topic affecting every public housing authority in the country, owns and operates public housing. Now, you might be thinking, doesn't a public housing authority always own and operate public housing? Well, some public housing authorities manage Section 8 programs and other programs that don't actually technically own and operate public housing. While 90% of public housing authorities do own and operate public housing, it's not 100%. That's why I gave the caveat. So this week's podcast, we're going to talk about asset repositioning options for public housing authorities. Now, by asset repositioning options, I mean alternative funding sources that housing authorities can access to pay for both operations and redevelopment of existing housing assets. We at Novogradac have been getting a growing number of inquiries from public housing authorities about what they can do to reposition their public housing stock. They may be wondering, why this sudden interest in public housing authority repositioning options? Well, the answer lies primarily with PHAs' growing concerns that over the next few years, they will be receiving less funding from HUD. More particularly, many public housing authorities are concerned that funding levels could decline to 80% or 85% of currently funded levels. And that has happened in the past. So here's a little background on how public housing is funded. Public housing authorities operate public housing properties with funds that are authorized annually by Congress. And generally speaking, there are two key buckets of funding. First, public housing authorities, or PHAs, receive an annual operating expense subsidy. And that covers costs such as routine maintenance, resident services, salaries, benefits, administration, utilities, and the like. Secondly, annually, public housing authorities also receive a capital fund to modernize and improve the public housing stock. Operating funds and capital funds are obviously very critical to maintaining quality public housing. And this brings us back to PHA's growing concerns that HUD funding levels will decline in future years. That's why now is the time for public housing authorities to be strategic in positioning their assets for the future. With that in mind, in today's podcast, we're going to explore the repositioning options available to public housing authorities, as well as the benefits and challenges of each. To do that, my guest today is Novogradac partner Rich Larsen. Rich should be no stranger to the Tax Credit Tuesday audience. He has more than 30 years of experience with public housing authorities and developers and developer clients as an accountant, auditor, and consultant. He's one of Novogradac's leading experts on all subjects related to HUD, as well as the RAD program, which is the HUD, and other aspects of the low-income housing tax credit program. We have a lot to cover, so if you're ready, let's get started. Rich, welcome back to Tax Credit Tuesday.
Thank you, Mike. And you did a great job, I must say, describing public housing authorities. Fantastic.
Thank you. So I did mention in my introduction that Novogradac has had a growing number of inquiries from public housing authorities about their public housing repositioning options. Maybe you could share some additional context as to why this is becoming an increasingly hot topic for PHAs as compared to the past few years.
Yeah, it really has, Mike. And I think it comes down to, a lot of the PHAs and their related associations, they're involved in a lot of state housing associations and a lot of comments coming out of Congress about cutting domestic spending, cutting discretionary spending has really kind of caught their ire a little bit. And I think nervous that, we're going to see those days back in the mid 2000s where there was recapture of public housing funds and deep subsidy proration. And so we're getting these calls, housing authorities looking at what can we do to keep what we've accumulated over the last couple of years and protect it and maybe even expand it. And so we've been getting those calls and we're addressing those issues of RAD and Section 18, and it's been very good.
And based on those calls, we're having this podcast.
Yes.
So in the intro, I very succinctly described asset repositioning as seeking alternative funding sources for operating and renovating existing public housing authority assets. Did you want to expand on that definition?
Sure, I think you hit it pretty good, but really for PHAs that are looking to do asset repositioning, it's the housing authorities that are that participate really in the public housing program. And it's really accomplished through taking the properties that are been poorly and inconsistently funded and transferring them really to a Section 8, the more stable Section 8 program, and really and modernize those public housing properties, rehabbing them and repositioning them in the market to do a lot better.
So let's jump into the details here and let's run
Great.
through just some of the options. So if you could share with our listeners the main repositioning options that are available to public housing authorities, and also if you get them in order,
Sure.
how often they're used.
Sure. I think anytime I'm thinking of asset repositioning, it's always the RAD program. Now, that's been around for 10 years. I think that is the most popular repositioning program. It's been widely successful. Then also the RAD program blended with the Section 18 program has become very good option for a lot of housing authorities that are in lower rent areas. And we're going to talk about that in a little bit. Section 22 streamlined voluntary conversions have been great for small PHAs, and that is a very viable option. Section 32 homeownership, and that's an option that's not used that much, but it is absolutely a very viable option. And then there's always the option that's really not an option, and that's the do nothing option, and that's maintaining the status quo. And unfortunately, there are circumstances where that happens, and we can get into that in a little bit as well.
So thank you for that, Rich. Now let's take a closer look at each one, and we'll start broadly with RAD. If you could provide a brief overview of RAD, listeners who may be unfamiliar with the program.
Sure. So the RAD program, which stands for the Rental Assistance Demonstration Program, it's a voluntary program. And what housing authorities do here is they're looking to preserve their public housing by jumping into a more stable Section 8 funding source in order to make needed improvements for property. So with that new funding source, investors and lenders are very confident and very comfortable with Section 8. So you can borrow and leverage those funds and go out to the tax credit market and conventional debt to get out of the public housing program and privatize your housing stock. I mentioned a little bit before, I think in my opinion, RAD has been incredibly successful since inception. It has resulted in over 223,000 public housing units being improved with an investment of over $16.5 billion so far. So it has done an incredible job. I think, yeah. So RAD, we've been heavily involved with it for the last 10 years, and it really has transformed public housing.
Would you say it's accurate to say that under RAD, the central aspect of RAD is your public housing authorities taking their annual operating expense subsidy and capital subsidy and converting it to a Section 8 rent subsidy?
Yes. So the initial RAD rent is calculated that way. If you do a straight RAD conversion, that is how your rent is calculated. And then the good thing about that is you get automatic OCAF adjustments, which is it's an operating cost adjustment factor adjustment or cost of living increase to your rent. And so lenders, investors are much more comfortable with that than being subject to the whims of Congress and the public housing program, which is a lot more susceptible to ups and downs. That you may get 95% one year and 90% another year. With a Section 8 program, even though it's subject to the whims of Congress, it's been fully funded for since inception.
Okay, so one of the benefits then of a RAD conversion is the Section 8 rents will be subject to annual OCAF adjustments, which are more dependable. What are some of the other benefits of a RAD conversion?
So you create access to private capital, which is fantastic because right now housing authorities cannot go out and borrow on and secure their public housing buildings because there's a declaration of trust on those buildings from HUD. So what HUD does is they relieve that declaration of trust on the property. And now as a housing authority, you can go and borrow against that property You can transfer that property into a tax credit partnership and receive tax credit equity on it. So it creates this whole new funding mechanism, to make capital improvements now, to fulfill a housing authority's capital need today. And then it also projects out their need for the next 20 years, and it satisfies that. So the access to private capital is huge. And then, enhancing housing options for residents. You have a resident who may have been in a building that's 35, 40 years old. Now they're going to have a modernized building, air conditioning, may have internet access, cable, beautiful community center. So things like that have really made RAD a popular program.
No, that's pretty compelling. It seems like the combination of stabilizing the funding that you're going to be getting from HUD through the Section 8 with annual OCAP adjustment, combined with the ability to now access private capital, it seems like those are the two key aspects of the benefits of the RAD conversion.
Yes, I agree.
So obviously compelling benefits for housing authorities. What would you say are some of the main challenges or obstacles that might make a public housing authority a bit hesitant
Yeah.
for RAD conversion?
Yeah. So I think the biggest challenge we're seeing for PHAs with a RAD conversion is the RAD rents may be too low when you do that conversion. You say, well, how can that be? Aren't they surviving on it right now? And it's budget neutral. You're taking that operating fund subsidy and that capital fund subsidy and converting it to Section 8. Well, with RAD, you have to finance your capital improvements. You have to put money away in a reserve account and so forth. So that RAD rent may not be enough to do that, to finance your capital need. So in that circumstance, what we the issue is a lot of PHAs, they get to that point and they say, RAD doesn't work for us. And we always try to talk to them and say, hey, don't throw in the towel yet, because there's a lot of methods out there, a lot of things you can do to increase your RAD rent. And you just and a lot of PHAs, unfortunately, don't know about that. And so that's great that they call us. I mean, if you're building in an opportunity zone, you can increase rent. There are utility allowance options that are out there to help you increase revenues. And one of the most popular methods right now is Section 18 blending, what I talked about a little bit before. Because if you can do a Section 18 blend, it brings in higher project-based voucher rents than what normally be utilized through a straight RAD conversion. So that's a big benefit. And that could make the difference of a deal working or a deal not working. So, so when you look at RAD rents, I always tell housing authorities, well, don't end the conversation there, because that's just the starting point.
Maybe you could build out this RAD with a Section 8 blend a bit. Just for our listeners, Section 18 of the Housing Act allows for demolition and disposition of public housing.
Right.
So if a PHA is interested in, or what should a PHA know about combining RAD with Section 18?
So the good thing, there hasn't been much change in the RAD regulations over the last couple of years, but one thing that did change was the Section 18 regulation, which it provides expanded eligibility for PHAs to utilize Section 18 in RAD conversions. So prior to this new notice, I think a PIH notice 2107, a PHA could blend up to 25% of their converted RAD units. And when I say blend, I mean bring in 25% of their units could qualify for the higher project-based voucher rent. So now they changed that where PHA can blend up to 60% of their units. And now it's based on a construction cost scale. So HUD publishes guide with unit levels, 1 bedroom, 2 bedroom, 3 bedrooms, and the expected construction cost. And if you exceed 90% of the HUD published amounts, you then can blend up to 60% of those RAD converted units utilizing project-based voucher rents. And if it's lower, if it's 80%, we'll give you less, 60% will give you less. And so wherever you land on that HUD published guide, that's the amount of units you can utilize through section and get the higher project-based voucher rent. So that really can make the difference of a project working and being financially feasible and not. And I've seen it make a huge difference in project viability.
So as I asked before with red, more generally, when you're looking at red section 18 blend, what are some of the drawbacks or challenges?
Yeah. Unfortunately, with Section 18, you need to have substantial rehabilitation to make it work. So you need to have high construction costs, and it's not effective for buildings that are in relatively good shape. And then also, you can't use 9% credits, which I know you're very familiar with. Can't use 9% credits with a Section 18 blend. So those are really the two big drawbacks there.
When you say 9% credits, and obviously you mean 9% local housing tax credits.
Yes,
For
yeah.
listeners
See,
that,
that's right.
aren't as
I sh-
familiar, but you mentioned 9% credits. How about 4% credits with private activity bonds?
Absolutely, yes. Yes, you can use those.
Okay. So now let's go to the third option on your list, and that was a streamlined voluntary conversion. Please explain to the listeners what
Sure.
streamlined voluntary conversion is and what it entails.
So if you're a public housing authority with 250 or less public housing units, you can just elect to leave the public housing program and leave your annual contribution contract behind. The good thing about that is you get those fair market rents. You get the project-based voucher rents there, but it's tenant-based assistance. So the negative part of that is that it's tenant-based assistance. And, when you give a tenant-based assistance, they can go somewhere else. So with the RAD conversion and the RAD blend, you're getting project-based vouchers. Here, it's very easy to convert if you have 250 units or less, but the tenants are getting tenant-based vouchers. Now, there are methods to project-based these vouchers, but the tenants have to consent to it. So that's a little bit of a con, but if you have 250 units or less, this is a very efficient, economical way to get out of the public housing program, to get into the voucher program and so forth. You just have to make a promise to HUD that you're closing out the public housing program and you're done with it, and you're going to use all your remaining public housing funds prior to conversion. So if you have reserves there, you need to put those reserves into your property, or they go back to HUD. And I've seen that happen a few times, unfortunately, where housing authorities were not aware of that rule and had $300,000 of reserves that they thought that they could keep. But unfortunately, in the Section 22 program, if you don't use it, it goes back to HUD.
So to maybe simplify it a bit, is in essence, if there's 250 or less public housing units in a public housing authority, they can take those units, move them outside the public housing rubric, but the tenants of the units have to be given vouchers themselves that are based, so that if they wanted to live somewhere else, they could live somewhere else.
Right. So you could have some vacancies.
Yeah.
And so that's the main drawback to this. But the funding, in a lot of these places, the voucher funding is much higher than the public housing rent. So it is a little bit of a windfall for the housing authorities.
So let's move into the fourth option you mentioned, Section 32 home ownership. Under what circumstances would selling public housing through Section 32 make sense?
Right. So we're talking about repositioning. How does selling constitute repositioning?
Right.
Well, so with Section 32, I've seen this a lot with when housing authorities have scattered sites. And so they have public housing units that are scattered sites, and they're just not very efficient to operate because of their location, and it could be on the other side of town and so forth. So what Section 32 does, it allows the housing authority to sell these units, and generally the repositioning comes in when the housing authority is going to take the proceeds of the Section 32 units and then assist with the RAD conversion and use those and create the units where the RAD units are going to be converted to, rehabbed or built. So you may have 20 or 30 scattered site units, and you have a public housing property on the other side of town that has 100 units. Well, now your RAD property, you're going to convert 130 units as opposed to just 100, and you're going to utilize those units there.
Got it. So, makes total sense. Thank you for that.
Yeah.
Some way it could be an adder.
Yeah.
Or because we talk about these options as if they're separate and distinct, but obviously there's overlapping usage.
Yes. In Section 32, the repositioning aspect is combining it with the other RAD programs because there's instances where you can just sell the property outright, but you know, that's not adding or repositioning it. It's more
Right.
selling something that's just been very unprofitable.
Right. It's disposition.
Yes.
Oh, the final repositioning option on your list, which really isn't an option.
Right.
It's really an option to do nothing, which doesn't look
Yeah.
like an option. When do you see that as an advisable
Yeah.
approach to basically wait
Right.
nothing now?
And like doing nothing for now is hard to accept. And I always say though, it's not we're doing nothing. It's just right now the repositioning doesn't work for us. And I've seen that in certain situations. So we already talked about when RAD rents in a particular area are low. So the straight conversion doesn't work. And then, we say, hey, let's look to the Section 18 blend. And then you say, well, the property just doesn't meet the construction cost criteria for the Section 18 blend. And, maybe they have too many units for a streamlined conversion. So sometimes it may be difficult. So what we tell the PHA is, hey, let's, try to let's identify what that financing gap is. And let's try to find some financing to bridge that gap. Maybe it's through a CDBG grant. Maybe it's through your state housing finance mortgage agency, things like that. Let's look outside the box because maybe if we can raise, X amount of dollars, now all of a sudden this deal works. So I don't want to say it's do nothing. We're not going to reposition right now. We're going to explore other options so that we can reposition because I'm a big believer. I've been involved, as you mentioned, in public housing for a long time. I'm not going to say the years again, for a long time. And I do think the future is not in public housing. And so these repositioning options, if it doesn't work today, we have to find a way to make it work for tomorrow.
No, that's a good point about having to seek other sources of financing, private or public, to close the financing gap. So maybe I could get you to share any concluding advice that you want to give the PHAs that are weighing their repositioning options.
Sure. We gave a brief overview of repositioning options, but it could get complicated. And I think management really needs to have an experienced team in place so they can really review the repositioning options in depth and be able to make the most informed decisions. So, if you're new to this process, and this is a little bit of a plug, we're having a Novogradac Affordable Housing Conference in San Francisco on April 27th and 28th. We're going to be conducting a 75-minute session on PHA's repositioning options. So that's one thing. Plus, it's a whole affordable housing conference for 2 days, talking about tax credit equity, conventional debt, financing, and so forth. But then also on April 26th, the day before, we're going to hold a RAD Basics workshop. And we're going to talk about, the nuts and bolts of the RAD program, including the history of the program, the benefits, how to apply, sample transactions, what type of RAD conversion fits your PHA. And we're going to talk about maximizing RAD rents and more. And so what we do in this conference is we really bring in all the top consultants and my Novogradac partners as well. And we're going to bring them in and you're able to talk with them and meet with them instead of trying to find them in a phone book. And they're going to be doing different sessions on tax credit equity, on the RAD program, on repositioning and so forth. I think that's a great place to start. I think it's really a beneficial conference. It's 26th through the 28th, and you can probably get more. I know you can get more information on the Novogradac website.
Okay. Thanks for that. Well, there's Rich's email address in this week's show notes for anyone who wants to follow up with them. Keep you from having to look him up in the phone book. So, Rich, please stick around for our off mic section of the podcast where I get to ask you some fun things. And also to our listeners, please be sure to tune in to next week's podcast. My guest will be my partner, Nadine, and he's going to discuss the potential application of the proportional amortization accounting method to renewable energy tax credit transactions. Proportional amortization is a GAAP, that's generally accepted accounting principles concept, that's currently widely used by investors or public companies to report in their financial statements the impact of their low-income housing tax credit investments. The proportional amortization method allows taxpayers to report tax losses along with tax credits below the line as a component of their income tax expense or benefit. So why is Net going to join the podcast to discuss this? Well, combination of last year's enactment of the Inflation Reduction Act, which created, expanded, and extended numerous renewable energy tax credits, along with the current work at the Financial Accounting Standards Board to expand the types of investments eligible for proportional amortization accounting. Well, the combination of those two has sparked a lot of possibilities for public company investors in green and renewable energy. So Nat will be here to discuss that. There'll be a lot to unpack, so I hope you'll tune in to next week to hear more. Now we've reached our off mic section where I get to ask our guests some off topic questions to get their words of advice, their words of wisdom. So Rich, I mentioned in the intro that you've been working in accounting long enough to know about phone books. More specifically, more than 3 decades. So you precede phone books, not party lines, but I won't go that far into detail. I know now that you did start your career that would have been helpful to you then.
Mike, when I joined Novogradac, I knew about our expertise in the low-income housing tax credit, and I just knew, how that could help my clients. Very excited for that. My PHA clients with RAD being a new program at the time. I mean, that was really the impetus of joining Novogradac. What I didn't realize was the depth of expertise in everything else. And I mean, we have a real estate valuation department. We have a historic tax credits experts, new market tax credits. We write books on renewable energy. And I figured it just took me way too long to bring all that expertise to my clients. And I don't know if I could have done it any quicker, but because of the vastness of what we do. But I mean, it's just something I incorporate regularly now in my client meetings. When somebody says something, I can say, hold on, I got somebody. How old's that building? Well, hold on. We might historic tax credits may be an option. And I know enough to know that I can call my partner when we talk historic tax credits. I call Tom Boschia. And so that's been the biggest benefit, I think, of joining Novogradac.
Great. Thank you for that. And you did reference the long-term tax credit in April in San Francisco. And I do look forward to seeing you there.
Yes.
I won't have to travel other than going across the bridge, but you'll be traveling across the country. So I thought I'd ask you if you have a travel tip to share with our listeners.
Mike, as you know, I have clients all over the continental United States. I have PHA clients, California, Washington State, Florida, Virgin Islands, New York, and I'm a little old school. So I like to visit my clients. The Zoom thing doesn't always work for me, although it's very popular, but I do like to visit my clients. And between attending Novogradac conferences, I travel quite a bit. So for me, I like to always use the same airline, the same hotel, and the same rental car company for all my travel. It helps so much with organization. Just think about it. If you travel a lot, you say, "Oh, did I rent my car last week?" And you don't have to go look at all the websites or all your apps to figure out if you forgot. So I always do that, and it helps with discounts. If you're a frequent user of a hotel, you're right on that app, and it helps you with discounts. And really, the biggest thing for me, it increases my efficiency. A lot of times with loyalty perks, for instance, with a hotel, I'll fly to from the East Coast to the West Coast for a early evening, late afternoon meeting. So I may arrive at the West Coast at 11 a.m. And because I use one hotel, I'll be able to get an early check-in. So I can check into a hotel at 11 a.m., freshen up, work for the rest of the day, and then go to my meeting, as opposed to, landing in my suit and going to the client looking like I slept in that suit because it's all wrinkled. So things like that, it may not sound like a big deal, but it does make a huge difference. Just getting some of those loyalty perks. Financially, it may not be a huge deal, but being able to do things like check in early to a hotel or get an upgrade on a rental car, things like that, really makes a huge difference when you travel a lot.
No, those are good points. I definitely follow that in terms of trying to consistently use different service providers so that you can definitely makes it easier. And do you have a travel bag that basically a duplicate of a host of sort of common items so that you don't basically ever unpack it?
I never unpack my toiletry bag. That is always, it is packed. And usually if I run out of something, I always buy it. I'll buy it on the road, but I never unpack. That is my go-to, because not having shaving cream in the morning or toothpaste is not a way you want to start your day. So
Plus, it took me a while to realize the benefits of just having duplicates of a whole host of items that just bag and never come out of the bag versus packing and unpacking,
right.
like you say, and then you getting to pack something. So if you travel a lot, that's central. So thank you again, Rich, and to our listeners. I'm Mike Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company, LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.